Question: what could be more exciting than talking about a graph? Answer: it doesn't matter, because we're talking about a graph either way, specifically this graph. This video is for investors that are excited by the recent S&P 500 US stock returns over the past few years. This is a mini market perspectives, and today we're taking a quick look at the S&P 500 as an investment. I'm Cam Irvin, lifestyle financial planner and advisor, and this is brought to you by Irvin Lending. What you see before you is a plain graph, right? Wrong. This is a fascinating graph, if you look closely. I don't mean you have to squint, just look for some patterns and some concepts. We have here three different indices: the S&P 500, and that represents a big chunk of the US share market. We also have the MSCI World X USA Index, and that means it's another 22 developed countries from all around the world. And finally, we have the MSCI Emerging Markets Index, which represents another 21 developing or emerging market countries. The graph shows each index and its trailing 10-year returns, separated by 5-year intervals. The first bars on the left show 1984, and what that means is it's taking the returns of each of these indices and for the previous 10 years, starting back from January 1975 through to December 1984. The next bars do the same, it's just coming 5 years later. Now here's where things get exciting. There are 9 periods shown on the graph from 1983 to 2023. But if you look at the S&P 500, which is the dark blue bar, it had the highest returns of any index in 4 of those periods. 4 divided by 9 is 44%. That means that less than half the time the S&P actually outperformed other diversified markets. So if you were back in the 1980s deciding which index to follow or invest in, the S&P 500 would not have been the best option more than it would have. That's not great. Many investors don't like the returns that emerging markets have offered, and that's understandable because for the past 10 to 15 years, they haven't been very good. But if you look further back, emerging markets were phenomenal during and after the global financial crisis of 2008. Part of the reason for that is because the S&P 500 did so poorly by comparison. We're not done yet though. Last time the S&P 500 outperformed these other 2 indices was in the late 1990s and early 2000s, and for those that remember, that's when the tech bubble burst. What came 5 years later were abysmal returns, because the returns on this graph, again, show the historical average 10 years, not just that 1 year. So what was once a great investment became a not so great investment. It's potentially scary to think that back in 1999 and 2004, the US outperformed other developed and emerging countries' share markets by less than what they've done recently. Let me explain. Markets go through cycles, which means there's up periods when everyone's happy, and after the up periods are down periods, where good returns were just a distant memory. In statistics, this is called regression to the mean, and what it means is that things have a tendency to go back and do what the average was over time. In other words, history often repeats itself. So imagine you and your friends are flipping coins. You flip a coin 10,000 times. There might be some streaks when you flip heads 10 times in a row, and that sounds like a lot, but out of a total of 10,000 flips, the odds are that all of the coin flips will still come out to be something like 50-50 or pretty close to it. This is how markets often behave, and because the S&P has done really well more recently, it might not do as well in the near future. Likewise, because other developed and emerging markets haven't done as well recently, they could be more attractive in the near term in the future. The more unusual a market's returns are, either bigger or smaller, up or down, the more likely it is to go and swing back the opposite direction to get back to what the average was. This is called a correction if it's on the downside, and if it's big enough, we call it a bear market when the stock market or share market plummets. Essentially, the S&P 500 looks so good right now because it's gotten more expensive. The price has gone up, so every investor is now paying more money to buy the same companies as they would have before. You can often measure how expensive a share market is in numerous ways, but some common ratios are price to earnings or price to book. This image shows the historical price to earnings ratio for the S&P 500, and you can see that it's been about 22, which means that if you bought all the companies in the S&P 500 and nothing else changed, it would take you 22 years to get your money back from the investment through each company's average annual earnings. You can see that more recently, though, the number is closer to 40 times price to earnings. So to put it another way, if you invest in the S&P 500 right now, you're roughly paying about twice as much as the historical average, which is not a good sign for the future returns. Since the year 1970, several countries have had better performing share markets than the US and the S&P 500, including Denmark, Hong Kong, Sweden, Netherlands, and Switzerland. However, if we look over the last 10 years, which again is the time when the S&P's gone way up, Hong Kong and Sweden haven't done so well. Sweden's trailing 10-year returns are 5.23% per year, while Hong Kong's are a miserly 2.03% per year. So if you like the idea that Sweden and Hong Kong have been incredible share markets for the last 40 years, but then only for the last 10 years, you don't like them due to their performance, well, that's how markets tend to operate. And if you're still excited by the opportunity to invest in the S&P 500, because maybe you hear things said like US exceptionalism, ask yourself this question. If the S&P 500 had not performed so well since 2009, would you still want to invest in it? And if the answer is yes, then go right ahead. But if the answer is no, and you think it's stupid to invest in a country that's had poor performance, such as Hong Kong or Sweden, then effectively you are chasing returns. And that's something we've mentioned in another video. The short version is, chasing returns is not a good investment strategy. While this might sound confusing and leave you wondering, so what do I do now? Here are some quick takeaways. Number 1, don't look at which investment markets have done well and put your money into yesterday's superstars. You'd be better off doing the opposite by picking previous losers, actually. But the best investment strategy is just to invest in all of them. Pick a global index that tracks all the countries in the world. Number 2, if you're investing your money into the S&P 500, just be aware that there have been numerous occasions when the S&P was in a similar position as what it is in today, where it was expensive, and it went on to lose value for quite some time, sometimes periods of 10 years or more. Number 3, this is the hardest part of all. Don't touch your investments. Let them ride. You'll be tempted to move them every time you look because the FOMO parts of your brain will ask if you can do better. In theory, yeah, you could. But in reality, the data are clear that switching investments based on recent performance is a bad idea. This means if you're committing to an investment strategy, commit to it. Don't try it out for a couple of years and then switch to something else that looks hot. Continuing to do that will hurt your portfolio and leave you with less wealth, less time from researching everything that you have to investigate, and increase your stress. So in short, chase your dreams, not returns. Our goal here at Irvin Wenborn is to help people live better lives by providing financial education, insight, and perspective. So if you enjoyed this video, feel free to reach out or share it with someone that you think would find it interesting or useful. You can find us at our website, email, or socials.